many investors say the most difficult about climate investing is the data, and the data, obtaining that data. It really relies a lot on the companies making publicly available all those metrics, all those numbers that are required to build indexes as an input. And when these numbers are not, when these inputs are not available, then we rely on estimation models. I think this is really what makes it really tricky.
Hello and welcome to The Greener Way. I'm Jamie Williamson, Managing Editor of Financial Standard and FS Sustainability, and today I'm happy to be joined by Sebastien Lieblich, MSCI's Global Head of Equity Solutions. Usually based in Paris, Sebastien is in Sydney to meet with various institutional investors and asset owners, and he's kindly made time to come and talk to us about the new phase climate investing is entering, evolving away from divestment strategies and high-level commitments towards practical implementation and support for businesses driving the energy transition. Sebastien, welcome to The Greener Way.
Hello, thank you for having me.
Sebastien, I thought it might be a good idea to start with a quick rundown of what your role entails and what kinds of things you're working on day-to-day at MSCI.
Sure. I'm spending most of my time these days going around the world and speaking with asset owner, institutional investors, and checking on them on where they stand with their sustainability and climate investment strategies.
And climate investing, it has taken a bit of a backseat in recent market discussions. Why does it still matter for institutional investors today?
Well, I think that climate investing is a structural question for them, right? So while we are observing, unfortunately, some geopolitical challenges, to say the least, climate investing, nevertheless, in the back of their head remains front and center because they have to basically deliver on the commitments they have done over the past years in terms of climate investing.
We are hearing more about a shift from commitments to implementation, though. So what does that actually look like in terms of portfolio construction?
That's a very good question. I think that we've seen a great evolution of climate strategies over the past, let's say, 3 years, where before, many institutional investors were focusing more on decarbonizing their portfolios, which is often referred to as paper decarbonization with very little, if no impact on the real world. Whereas today, they're really focusing much more on what is called financing the transition, i.e., really investing in those companies, even if they are heavy emitters of CO2, to help them get capital to transition over to production processes, for example, which are better aligned with a lower carbon economy.
Obviously, part of what MSCI does is indexes. How are climate benchmarks evolving to support this shift that we're talking about, particularly in balancing those transition goals with the need to still have a diverse portfolio?
Again, this is very much linked to this move to financing the transition, philosophically speaking. In practice, how does it translate into index or benchmark construction is that we've seen many investors adopt much more holistic approach to investing in the entire investment opportunity set, while tilting the exposures or the investment in companies with higher weights in those companies which are better positioned to transition to a low carbon economy, moving away from exclusions that would just simply exclude companies from getting the capital they drastically need to finance this transition over to the lower carbon economy.
You've just touched on exclusions, and there's been a lot of discussion around moving beyond that. There are a couple of recent examples that we've seen. Ontario Teachers' Pension Plan, they introduced a new climate strategy recently under which it's choosing to work with businesses to decarbonize their operations. I think it was late last year, there was the oil fund, Norway's big sovereign wealth fund. They also paused divestments for 12 months because they kind of recognized that maybe their guidelines needed to be updated to better reflect what's happening today in terms of climate investing. In terms of what you're seeing, though, how are investors approaching transition strategies in practice, especially in sectors like energy?
Well, I think that the major reason, there are two major reasons why investors have moved away from exclusions into remaining invested in each and every company, depending on how much capital they need to transition over and how ready they are to transition over. One is financing effectively this transition. And the second one is getting a seat at the table when it gets to influencing the companies. If an institutional investors divest from a company, they lose their engagement power with the company itself. If they are heavily invested into a company, they can vote. They can start to influence the management of the company on their path to transitioning to a low-carbon economy.
Closer to home, we've seen Aware Super commit more than $50 billion to a transition-based climate benchmark, which was developed with MSCI, moving away from those exclusion-based approaches. What does this actually signal in terms of how institutional investors are approaching climate investing?
Well, I think what is really exciting, and we really enjoyed working with Aware Super, is the fact that Aware Super was quite innovative in the way they were looking at the transition, because rather than looking at backward metrics to build the index, they were looking at forward metrics, right? Like, do companies have targets, for example? How are they executing on targets, right? So that this drastically changes the picture, because rather than assessing the company in a context of how much they did emit in the past, it's much more around how much is expected them to emit in the future, right? So that's a drastically different view, which is much more forthcoming and moving in the right direction when it goes to climate investing.
Was Aware Super kind of, I guess, unique in that approach? Is that sort of one of the first big asset owners that you've seen take that really innovative approach?
There have been selectively, in EMEA specifically, a couple of asset owners that have embarked on the same way. But I think what makes this move from Aware Super very different from others are the 50 billion, right?
Yeah.
It's a large amount of assets that have been committed to climate investing. And I think that's probably one of the largest commitments in terms of assets that an asset owner has made so far.
What are the biggest challenges in measuring and incorporating climate risk and transition progress into portfolios today?
I think at the end of the day, it's the disclosure, right? It's many investors say the most difficult about climate investing is the data, obtaining that data. It really relies a lot on the companies making publicly available all those metrics, all those numbers that are required to build indexes as an input. And when these inputs are not available, then we rely on estimation models. I think this is really what makes it really tricky. And then the second part, which makes it really tricky, is the fact that climate investing is still very much evolving. Climate science is still very much evolving. So the methodologies have to evolve. So a construction methodology which is valid today might actually be out of date, if I may say, in 3 years' time, and will need to be enhanced or revamped.
Is that why certain companies, so for instance, the oil fund, Norway Sovereign Wealth Fund, their climate strategy that I mentioned earlier that they brought out, it's only 2026 to 2030. It seems like a really short period of time, but is that kind of why? Like you don't really know what's going to happen within another 5, 10, 15 years after that?
You are absolutely correct. While, again, a couple of years back, companies were making commitments to 2030 and then 2050, right? Most companies now make commitments over the next 5 to 7 years max because of exactly of those reasons of the data, the science, the methodologies having to evolve over time.
Looking ahead, what is it that you think is going to define the next generation of climate investing and benchmark design for institutional investors?
I think there is one element which is coming up more and more in my discussions with asset owners, is the fact that, unfortunately, I might say, there is kind of a realization that an orderly transition might actually not happen, that we will not reach 1.5 degrees by 2050. It's going to be any temperature measurement higher, 2 degrees, 2.5, even potentially 3 degrees. So there is increased focus on climate physical risk, right, as a complement to transition. I'm not trying to say that asset owners now completely ignore transition. Not at all. They continue to invest in transition. They are committed to transition, but they want to complement their approach with physical risk consideration, because there are some companies that will have assets, factories, logistical hubs that are operating in sensitive areas and that might be hit by climate physical risk. And hence, they want to be protected. They want to have some downside protection. And they are asking us now at MSCI to develop methodologies that could potentially be used to shield them from that specific risk emerging from an unordinary transition.
In addition to that, and just finally, what other things are you hearing from institutional investors in Australia and across the Asia-Pacific region when it comes to climate investing priorities?
I think that a topic which has come up over the past couple of weeks and or a topic which is specifically related to the geopolitical situation that we're witnessing is about the energy supply chain and a potential refocus on renewable energies to try and curb the over-dependency on oil and gas from the Middle East as an energy source. So this is really a topic that is coming at the forefront in all my discussions I had, specifically in the APAC region. And I think this will give us a lot of thoughts in the future on how we can put energy transition and the renewable energy part of it much more at the forefront in the development of new index solutions.
And there's no concern at all that what's happening currently might almost, I guess, do the opposite, just because it does take so much time and investment to build infrastructure for renewable energies and that kind of stuff. Is there's no concern that people might become a little bit more reliant or push for, I guess, coal and the sorts of things that we've been trying to move away from?
I think that's absolutely correct in the very short term, right? As an immediate stopgap measure, if I may say. But for the longer term, there is also some arguments which are being made that there might be some more interventions from the different government and the regulation to push renewable energy. Specifically, if I move out of the region for a second in EMEA, there is from European asset owners really the point being made that the different governments in Europe and the European Union as a whole might actually do a regulatory push to promote renewable energy, again, to curb that over-dependency to the east from a gas and oil perspective.
Well, Sebastien, many thanks for sharing your insights with us and contributing to this obviously very important conversation. Thank you so much for joining us on The Greener today.
Thank you so much for having me. It was a great pleasure.
The Greener podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.